Welcome back as we learn the impact of potential GDP growth on investment decision in an economy. We shall study this from the perspective of equity markets and fixed income markets. Let's get started. We concluded our last lesson with the growth accounting relations, where the growth in potential GDP can be expressed using Solow's approach or using the labour productivity approach. Potential GDP is defined as the maximum amount of output an economy can sustainably produce without inducing an increase in the inflation rate. Very often, the long-term growth rate in potential GDP of an economy is also known as the sustainable growth rate. One question often debated is the relationship between the sustainable growth rate of the economy and the long-term growth rate of equity prices. Simply put, if the sustainable growth rate of an economy is 3%, can equity prices grow sustainably at 5% each year? Let's examine this. We've learnt in Level 1 that the price of an equity should ultimately reflect the earnings potential of a company. If we let P represent the aggregate price of equities and E represent aggregate earnings, we can write the following relationship. This equation can be expressed in terms of percentage change over time. So, over one time period, we would expect the growth in equity prices to be equal to the growth in GDP, plus the growth in earnings relative to GDP, plus the growth in PE ratio. In the short run, equity prices may not follow such a relationship, as prices are primarily driven by short-term market risks and market sentiment, so this should only apply in the long run. However, in the long run, the growth in earnings to GDP ratio cannot be consistently positive or negative. A rising ratio for corporates means that the labour force is consistently getting a smaller share of the GDP, which cannot be the case as the labour force will stop working. Neither can the ratio decline forever, or else unprofitable businesses will disappear. Therefore, the change in this ratio over the long term should be approximately zero. Likewise, the change in price to earnings ratio cannot be positive or negative indefinitely, because investors will not pay an arbitrarily large price for a unit of earnings, nor will they give away earnings for nothing. The change in PE ratio over the long term should also be zero. So, we're left with this simple relation where in the long run, the growth rate for equity prices is equal to the potential GDP growth rate. In essence, the growth in aggregate stock market prices has to match the growth in potential GDP. So, a consistent outperformance of the stock market against potential GDP growth is not sustainable in the long run. For fixed income investors, the effect of potential GDP growth rates is not as straightforward as that for equities. Potential GDP can affect fixed income securities through mechanisms such as inflation rates, real interest rates, credit risk, monetary policy, and fiscal policy. Let's briefly study each of these effects. First, recall that potential GDP is defined as the maximum amount of output an economy can sustainably produce without inducing an increase in the inflation rate. Therefore, when the GDP growth rate is above the sustainable growth rate, inflation pressure builds up, which puts corresponding downward pressure on bond prices. Rising inflation makes fixed income investments less appealing as the fixed amounts of future payments become less valuable. Secondly, potential GDP also has implications for real interest rates and real asset returns. Positive growth in potential GDP indicates that future income will rise relative to current income. When consumers expect their incomes to rise, they increase current consumption and save less for future consumption. To encourage consumers to delay consumption, investments would have to offer a higher real rate of return. Therefore, higher potential GDP growth implies higher real interest rates and higher real asset returns in general. Third, potential GDP growth affects the credit quality of fixed income securities. A higher sustainable growth rate reduces credit risk, as both the government and corporates are likely to be in better financial positions to pay off their future debts. Fourth, gaps or excess in potential GDP are usually signals for central banks to ease or tighten monetary policy. When interest rate decreases, bond prices increase. When interest rate increases, bond prices decrease. And finally, in addition to predicting monetary policy, the output gap can also be useful in analysing fiscal policies. Government budget deficits typically increase during recessions and decrease during expansions. Increased borrowing to fund the higher fiscal deficit may weaken the creditworthiness of government bonds, so yields may increase. And these are the various avenues through which the potential GDP growth rate of an economy can affect the fixed income market. As mentioned earlier, the effects are not as straightforward as that of equities. In fact, some of the influences can be conflicting, so it requires you to understand the fundamentals of bond pricing to make investment decisions. And that's all for this quick lesson where we studied the impact of potential GDP growth on equity and fixed income markets. We resume our study on GDP growth factors in the next lesson by discussing some of the other types of inputs that influence potential GDP growth. See you again.